There are dozens of established option strategies that provide traders with opportunities for profit if they learn exactly how these strategies work. I'm Seth Froiberg, the head trader of SMB Capital's options trading desk here in Manhattan, and the traders here on our desk grow through constantly exploring new strategies, backtesting them, and then rolling them out as live trades if their backtests reveal that the strategies have an edge. In this video, we'll be covering the details of a strategy known as the double diagonal, and a really interesting technique for trading the double diagonal that I think you're going to find intriguing. So stick around so that you can learn how this trade works. Hi, I'm Seth Froiberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Okay, so one of the things that options traders like to develop are strategies that can be traded throughout the year, once or twice a month, using a fixed series of trading guidelines for income. These kinds of repetitive strategies are almost always executed using index options because index options represent a basket of diversified stocks, and very importantly, index options don't have earnings events like individual equity names have. That's important because for these kinds of strategies, the less price movement, the better. Whereas equities will usually react in extreme ways to earnings releases, which can play havoc with strategies like the one we'll be discussing in today's video. So because the example we'll be using involves index options, we're going to do a really quick review of how index options work. So those of you familiar with how they work, just hang in there. This is going to be very quick, and then we'll jump back into teaching you how this approach to trading the double diagonal option strategy works. All right, so think of an index option as a bet. What are known as call options pay off if the index closes above what's known as the strike price of the option on the day that that option expires. If the index does close above that price on expiration day, then the call buyer gets $100 per point that the market closes above that call strike price. A put option is the exact opposite. It pays off if the market closes below the strike price of the put option. Again, $100 per point that the market closes below the strike price of the put. So for example, if an index closes at 40.32, then the 4,000 call would pay $3,200, as you can see from the calculation, because the index closed 32 points above the strike price of the call, which is 4,000. However, the 40.75 call would expire worthless as the index didn't close above 40.75, so the call seller just pockets the premium. And the puts are just the opposite. If the market closed at 40.32, then the 40.75 put would be worth $4,300 because the market closed 43 points below the put's strike price of 40.75. But the 4,000 puts would expire worthless because the market didn't close below the 4,000 strike price. Okay, so now with that as background, we'll run you through an example of how you can use SPX index options to trade a strategy called the double diagonal, as we mentioned before. So let's head back to November 16th, 2020. And as you can see, the S&P 500 index with the trading symbol SPX had bounced off of the COVID-19 crash lows in March of that year and had actually hit all-time highs by November. And so November 20th, the index was trading at 36.21. So let's take a look at how we get this trade started by checking out an options chain that expires on December 2nd. And what we'll do is move up 70 points from where the market is trading and buy a call there at 36.90, and then move down to 35.50 and buy a put there. And we'll do this simultaneously. Now to options traders, and I know this sounds weird, but the name of this is a long strangle, where you own both a put and a call at a distance from where the index is trading. usually equidistant from each other like they are in this example. And the reason that we chose to move out 70 points from where the market is currently trading can be covered in another video. But for now, just know that this was not selected randomly, but instead had to do with how volatile the options market believes that the index will be in the near future. Okay, so now if you take a look closely at that options chain, you're going to see that the call cost $20.40 and the put cost $32.65. Now, to break that down cash flow wise, you'll see that we paid $20.40 for the call, but remember that pays off at $100 per point for every point the market closes above 36.90. So you multiply that by 100 to arrive at a total cost of $2,040 for the call. And the put undergoes the same calculation, resulting in a $32.60 cost for that one, which comes to a total of $5,305 for the long strangle. Okay, so that's the starting point of the trade. Now, before we get further into exactly how this strategy works, I wanted to let you know that beyond what we're teaching you in this video, there are a large number of sound, viable long-term techniques for trading options for income. And in that regard, we're currently running a 2-hour free intensive workshop where we'll be teaching you 3 of those strategies that real professional options traders use. In that webinar, we'll be teaching you a really simple but incredibly effective strategy that some of the greatest investors in the world use all the time, plus an options trading strategy that has a statistical 80% probability of profit month in and month out, plus an option strategy that you can employ with a stock that you like, where you'll make your target profit whether the stock goes up, goes nowhere, or even goes down a small percentage. So if you'd like to learn these strategies, then just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open the free registration page in a new window, so don't worry, you won't lose this video. Or you can register at optionsclass.com. It's not often that retail traders can be taught strategies employed by actual Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. Getting back to the trade, what happens next is that the trader picks the next options chain in time, which in this case is 3 days out, expiring on November 18th, and the trader this time sells a call, this time 50 points above the market price of SPX, up at 36.70, and simultaneously sells a put, this time 50 points below the market price, down at 35.70. And so this transaction is called a short strangle. And in this case, it's located in a closer options chain in time than the wider strangle we bought expiring on December 2nd. Now this formation, a short strangle closer in time and a long strangle farther out in time, is what is known as a double diagonal to options traders. So first off, let's recognize that by selling these options, we're receiving cash from that transaction. And as you can see from the calculations, in this case, we're receiving $1,273. Okay, so keep that in mind as we move forward to very close to the end of the day on November 18th, the day that these short options expire. And you'll see that the SPX is now sold off a bit down to 35.81. And so the way this technique works is that the trader now buys back those short options at 36.70 on the call side and 35.70 on the put side, and then reopens the exact same short strangle on the options chain that expires on November 20th, a few days later, selling those same strikes, but in the next options chain. And as you can see from the pricing, both the short put and the short call have gotten pretty close to worthless, because this is being done 15 minutes before the expiring options on November 18th are about to expire. And the 36.70 calls are way above where the index is trading now, and the 35.70 is 11 points below the price of the index with only 15 minutes left. So that has almost no value either, and so to buy those back is cheap. But if you look at the 36.70 call in the November 20th chain, you'll see that one has about 57 cents of value, which isn't much, but it's something, while the 35.70 put on the chain is worth a bunch, 16.22, and that's because the market now has until November 20th to move past 35.70 for that to have value, and that certainly could happen over the next few days, giving that option a healthy value. So if we now move to the cash flow implications of this again, we see something interesting emerge, and that is if we take that original December long strangle cost and subtract from it the cash we got from selling the original November 18th strangle, and then add to it the cost of buying those back much cheaper right as they're about to expire, and then we subtract out the cash we received from reselling the 3670 strike for the November 20th expiration, and doing the same for the 3570 put, as you can see from the calculation, the cash outflow is now down to $2,401. And I'd also like you to focus on the fact that the roll itself creates positive cash flow. Why? Well, think about it. Anytime you pay for an option closer in time and sell one at that same strike farther in time, you're going to receive cash. Why? Because there's more time left on the ones you're selling than the ones you're buying back, and so they're worth more because the market has run out of time to invade the strike price of the short options because they're expiring any minute now, while the new short options have a few days left on them, and so the risk to the seller of those options is higher that they could be invaded, especially options like the 3570 put close to where the market is at the time you're rolling the options. And so that's just something that will always be true, and therefore rolling options in a double diagonal campaign will always bring in cash if you keep the short options at the same strikes as the ones you're buying back. Okay, so now let's move to near the end of the day on November 20th. And as you can see, the SPX has sold off further down to 3571. And so again, we'll just buy back that 3570 put and the 3670 call and resell them into the next options chain, which comes up on November 23rd. And again, this time, as you can see from the calculations, buying back the call and put was relatively cheap, but we got really nice positive cash flow from selling the options in the November 23rd chain. So now let's take a step back and look at the cash flow scorecard so far on this campaign. And as you can see, when you take into consideration the original cost of the December 2 long strangle, subtract out the original short strangle cash flow you received on November 16th, and then added in the cash flow you received from the rolls that took place on November 18th and November 20th, you'll see that the cash outflow has now dropped to a little bit more than $1,000 from the original outflow of over $5,300. So quite a reduction. And so we won't run through the minute details of every single roll, as that'd be too much. But as you can see, if we had continued this exact process of closing the options moments before they expire and rolling them into the next expiration cycle up through the last expiration before the December 2 expiration, which is the November 30th options chain, with each roll we received more and more cash until finally on November 27th, when we rolled from the November 27th chain to the November 30th chain, when you factor in the original short strangle and add in the positive cash flow from all the rolls combined, we ended up with positive cash flow now of $442 because we kept collecting cash flow with each roll. So now let's move to the day those November 30 options expire, and we can see that the index closed at 3621, which means that both the 3670 put and the 3570 puts expired with no value because the call has no value unless the market closes above its strike price, and the put has no value unless the market closes below its strike price. So they both die and go to options heaven, meaning the only thing left in the trade is those longs that were the original trade before we started this campaign on selling short calls and puts against it, forming the double diagonal structure over and over again. So now all that is left to do is to close the long calls, which are now worth $172, and the long put worth $217. And so now at this point we can examine our final cash flow, which, as you can see, resulted in, after factoring in all of the credits we got from selling and rolling options against the original long strangle, subtracting out the original cost of the long strangle, and factoring back in the residual value we got from those long options, resulting in a profit of over $831 in 2 weeks, a return of over 15% in 2 weeks. And so what I'd like you to take away from today's video is that options income trading in many cases is a simple process of selling short options against long options until you squeeze so much credit out of those short options that the cost of the long options is exceeded by the profit you receive on the short options, resulting in really strong returns once you learn how to structure strategies like the campaign double diagonal in a disciplined manner. Professional traders utilize concepts like this all the time in their trading, and with a little bit of training, you can do the same for your own account. Now, just to remind you, if you're serious about your trading, you need to check out the free intensive options class that we're currently running, where you'll learn 3 real-world option strategies that our professional options traders use all the time. Just click the link that should be appearing now at the top right corner of your screen, or you can just head on over to optionsclass.com to register for this free workshop directly. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and before you miss it.